You've worked hard over your life to accumulate what you need to create the retirement of your dreams. Don't let the IRS step in and blow it all up. For many retirees, they picture their future retirement as a way to enjoy all their newfound free time, spend time doing things they never had the opportunity to do before, or spend time with people they love and care about. They don't think about how the IRS could step in and spoil it all. I don't know about you, but I've never met somebody who wants to pay the IRS more than they legally have to. And if you're the same way, listen up. This video is for you. My name is Derek Delaney. I'm a certified financial planner, and these are the type of conversations I have with my clients to help them achieve the retirement of their dreams. Not wanting to pay the IRS more than your fair share is a very intelligent move. Unfortunately, for a lot of newly retiree individuals, they inadvertently make mistakes that make that not true. And one of the easiest ways to get around from doing that is to create tax diversification for yourself in retirement. And when we think of tax diversification in retirement, we think of the three different categories your money could fall into, and specifically how that money is taxed. So category one is money that's taxed today. That is bank account money and taxable brokerage account money that earns some sort of income or dividend, and you are taxed on that via a 1099 at the end of the year. Category two is money that is taxed later in life whenever you pull it out. So for most people, that's 401k, 403b, and IRA money. You're not taxed on that until you actually take that money, pull it out of the account, and spend it at some future date. And then category three is the holy grail of retirement planning, is that is the tax never category, specifically Roth accounts, where you put money in those accounts, those monies could continue to grow, and you could spend that money later in life tax-free. And for some people, more important than that is their beneficiaries can inherit that money. And if done right, those inheritees can spend that money completely tax-free as well. So creating tax diversification within those three categories becomes very, very important, specifically when we're dealing with the first two categories, which is tax now and tax later. Meaning, how do those taxable brokerage account long-term capital gains play with taxes that you'll have to pay later when you withdraw money out of IRA, 401k, and 403b accounts? Let's take a look at the difference between those two, specifically from a tax category or tax bracket category breakdown. The first thing you're going to want to know is ordinary income tax brackets, or the tax brackets that your IRA, 403b, 401k monies will be taxed in when you pull that money out later in life. It's the same ordinary income tax brackets that your W-2 wages will run through while you were still working. And currently in 2025, those brackets are 10, 12, 22, 24, 32, 35, and 37%. And as you can see, the more money you make, the higher your federal income tax bracket goes. But it doesn't mean that all of your money is taxed in that higher tax bracket. It just means that the next dollar earned, if you cross that threshold, will then be taxed at that higher rate. The first $23,850 in this example is taxed at 10%, and then the next $12,950 is taxed at 12%, meaning you have a blended rate between 10 and 12%. You compare that to long-term capital gains, and this is money that is in that taxable brokerage account we talked about before. And if that money has created profit and that profit has been created over the course of 1 year or longer, it is considered long-term capital gain. And the really nice part about long-term capital gains is that they are taxed in a 0, 15, and 20. And you can see here that you can have almost $96,700 of taxable income. And if all of that taxable income is long-term capital gain, you'll pay 0% tax because that 0% rate is applied to the first $96,700. What is important to know, though, is how long-term capital gains and ordinary income play together when they both show up on a tax return within the same year. And the important thing to know is that long-term capital gains stack on top of your ordinary income. As your ordinary income grows throughout the year, it will push your long-term gains into higher long-term capital gain income tax brackets, the 0, 15, and 20%. However, since long-term capital gains stack on top of ordinary income, as your long-term capital gains continue to grow, it does not affect where your ordinary income gets pushed to in those ordinary income tax brackets, 10, 12, 22, 24, and so on. Long-term capital gains do not affect your ordinary income when it comes to what you pay in tax, but ordinary income will affect what you pay in tax on your long-term capital gains, because that could push your long-term capital gains up into higher long-term capital gain tax brackets. For example, you could be sitting there in the zero, and then you add on more long-term, or you add on more ordinary income because you take a big IRA withdrawal, or you convert money from an IRA to a Roth IRA, and that could push your long-term capital gains from that 0% bracket into that 15% bracket. So it's important to be aware of how those two different type of taxable income sources you could experience in retirement will affect each other. So let's look at a specific example to provide more clarity and context on how that works. Here in this example, we have Mike and Sarah, where they have total income of $160,300. And after their standard deduction, their taxable income is $128,800. Now, it's important to note, of that $160,300, $80,000 are long-term capital gains, and another $12,000 are qualified dividends. So this $12,000 and this $80,000 will fall into those long-term capital gain brackets. Everything else is considered ordinary income. So if we come down here, of that $128,800, only $36,800 is considered ordinary income. And you can see here that of that $38,800, the first $23,850 falls into the 10, and the next $12,950 falls into the 12% bracket. Not bad. The real benefit comes where the other $92,000 of the $128,800 that is taxable income is considered long-term capital gains. That $92,000 again comes from the $80,000 of long-term capital gains and $12,000 of qualified dividends. And you can see here, because this long-term capital gain gets stacked on top of this ordinary income, and this ordinary income is only $36,800, and we can have up to $96,700 of taxable income before we fill up that 0% bracket. It means the first $59,900 of this $92,000 long-term capital gain will fall into the 0% bracket, because the first $96,700 of income apply. And if the first $36,800 is ordinary income, it means we have $59,900 of additional income that we can apply in these long-term capital gain tax brackets that will hit that 0% rate. And then the other $32,100 falls into that 15% bracket. In this situation, you have somebody who earns $160,300, and their average tax rate that year is only 5.5%, which is phenomenal. That is a good way to marry, for most people, tax later money, IRA withdrawals, with long-term capital gain monies, which is money that is taxed now in that first category that we talked about before. So how could this be played out differently in a worst case scenario compared to what we just looked at? Well, let's look at the same exact scenario. Total income for Mike and Sarah of $160,300. $128,800 of that money is taxable. We come over here and we look at qualified dividends. Now we're reduced from $12,000 to $2,000, but we still have our $80,000 of long-term capital gain. Well, since those qualified dividends were reduced from $12,000 down to $2,000, we need to take an extra $10,000 withdrawal out of their IRA to hit the $160,300 total income goal that they need. Well, because that extra $10,000 was drawn out of their IRA, it means instead of having $36,800 in ordinary income like we had before, it gets bumped up to $46,800 of ordinary income, which means their ordinary income tax actually increases. And because long-term capital gains stack on top of ordinary income, this becomes important because now there is more ordinary income underneath the long-term capital gains, which means more of that will be pushed up into that 15% bracket. As you can see here, only $49,900 of the long-term capital gains in this scenario fall into that 0% bracket, where before it was $59,900, which means $10,000 more fall into the 15% bracket than it did before. So of the $82,000 of long-term capital gain, more of that falls into the 15% bracket instead of the 0% bracket in the first scenario, because this ordinary income is larger in this scenario. So as long-term capital gains get stacked on top of it, less will hit that 0% bracket and more will hit that 15% bracket. When this scenario, their same total income applies, their same taxable income applies, they just pay a higher average tax rate, which will total more taxes owed from a federal standpoint this year than what they paid in the previous example, even though their total income is exactly the same. Understanding how long-term capital gains fit with ordinary income and how ordinary income can push long-term capital gains into higher brackets is very, very important, because that will affect where you take money from, given what tax environment you want to experience that year. And it will affect the other tax strategies you may want to utilize in any given year in retirement, like Roth conversions. It's also important to note that there are other beneficial reasons for why you could want more long-term capital gains on your tax bracket or on your tax return in any given year. The first big one for a lot of retirees is those who retire before they get to age 65 and hop on Medicare. If you have a lot of long-term capital gain money on your tax return in a year and very little ordinary income, you most likely will show very little taxable income on your tax return that year, which means if you go out to a state or federal exchange to buy your medical insurance, you're going to show very little income, which means you're going to qualify for medical insurance with premiums that are much lower than if the majority of your money was ordinary income, which would shoot your taxable income up, meaning you'd have to pay more medical insurance. Having a lot of long-term capital gains as your primary source of money early in retirement, if it makes sense, to lower the cost of exchange medical insurance, could be very beneficial. The other nice part about having great diversification in that taxable tax now category, in that taxable brokerage account, is if you don't spend all the money yourself and you still have significant gains in that taxable account, your beneficiaries will inherit that money completely tax-free, just like Roth IRA money, because they will get what we call a step up in basis, meaning all that tax liability that applied to you in your taxable brokerage account while you were still alive goes away, and your beneficiaries get to inherit all of that money tax-free, just like they would Roth IRA money. As you're approaching retirement, or if you get close or newly entered into retirement, keep an eye on your tax diversification and understand the pros and cons of where your money's at and how it tax could or could not be beneficial to you given your specific goals and tax strategies in retirement. If you're looking for a financial advisor, planner, retirement planner who incorporates this type of work proactively every single year throughout retirement for their clients for a single flat fee, no AUM or commission products, I invite you to learn more about my firm, to schedule a consultation where we could talk more about this and other stuff for absolutely free. Just click the link below, schedule your conversation. I'd be happy to share more about how these type of tax strategies could or could not be beneficial to your future retirement. Until that future conversation, happy retirement planning.